Hey everyone, thank you for tuning in to another episode of the Basem Hanna Podcast. Today I want to talk to you about the different ways to invest in professionally managed real estate in Canada. So I think the first major categorization that we need to talk about or look after is there's private real estate investing and there's public real estate investing. Private real estate investment typically happens through limited partnerships, which we'll get into, and then public real estate investing typically happens through a stock market or some kind of an exchange where you're buying a REIT, which is a real estate investment trust, or a public real estate corporation. So let's focus on the public market first, and then we'll get into the private investing stuff. On the public market side, the two main ways to invest are through a real estate investment trust or a public corporation. A real estate investment trust is a very specific investing entity that has rules around what kind of investors they can take on and what kind of investments they can make and what they can do with the capital that's being earned. What I mean by that is real estate investment trusts are predominantly designed to buy income producing assets. That means things that have already been through the development cycle or that are actively producing in place income that can be distributed to the unit holders. The second most important part about that, and the reason why REITs are required to buy income producing assets, is that a REIT is required to distribute a certain percentage of all of the income that it makes back to its unit holders through a dividend. The reason that all of this is done is that REIT vehicle is mainly built to allow passive investment in income producing real estate. So they set out the rules very clearly. They're like, you can only buy income producing assets, or the vast majority of the assets that you buy in a REIT have to be income producing. And once that money is made, it has to be distributed, or a large percentage of it has to be distributed back to the unit holders in the year that it's made. So that's the REIT. Also on the public side is full-blown real estate corporations. And what that is, or the difference between that and a REIT, is a REIT only buys income producing assets and has a specific mandate to produce income. Publicly traded real estate company operates very much like a private real estate company, except for the fact that it's public and that its shares are traded on an exchange, and people can buy and sell shares of that company based on the company's strategy and their historical returns and their prospects for the future. But they are not limited to buying only income producing assets. They can do development. They don't have to distribute all of their cash flows. They can keep it, they can reinvest it, they can acquire more real estate, whatever it is that they need to do. But there's a lot more freedom and flexibility to be a full-blown public real estate company than there is to be a public REIT, or a real estate investment trust. The nuance or the difficulty behind both of those is that they're both regulated by government bodies that ensure that there are certain checks and balances in place to protect the quote-unquote unsophisticated investor. You know, if Joe Blow off the street doesn't know anything about real estate and they want to invest their money in the stock market, there's regulators that are put in place to ensure that these public vehicles that they have that Joe Blow has the option of investing in are managed properly, that they do their accounting in a certain way so that everybody is comparing apples to apples, and it's just generally more of a compliant atmosphere that needs to be worked in, and it's limited to companies that have a great deal of access to capital and a large portfolio of assets which they manage. That's the public side of the real estate, the professionally managed real estate world. Then there's the private side of the real estate world, and that is and that's the area that I operate in, and vast majority of things that happen in there happen through limited partnerships. What is a limited partnership? A limited partnership is very similar to forming a corporation, except a limited partnership is a flow-through vehicle, and I'll explain that. That's a tax term. So in a corporation, you would make money, and the corporation is technically a legal entity in the eyes of the government. So it has to pay tax, like the corporation has to pay tax, and then once that money leaves the corporation and goes into the hands of the different investors, they have to pay their own personal tax. A limited partnership is a flow-through vehicle. So what that means is that you can take the money that the limited partnership makes doesn't get taxed at the limited partnership level. What happens is that money flows through to the investors that form the limited partnerships, the limited partners. It flows through to them, and they pay their individual tax on their specific structure. So more simplistically, a corporation gets taxed, and then the investor gets taxed after that. A limited partnership, the corporation does not, or the partnership does not pay tax, and the limited partnership at their personal level pays the taxes that they would have to pay on the partnership's income. That's from a tax perspective. From a risk perspective, limited partnerships are a little more exciting than the public stuff because you're allowed to do a lot more inside of a limited partnership. They are less heavily regulated, which is a pro and a con, but the pro is that it allows you to do slightly riskier real estate deals that can offer you higher returns. For example, Omega forms limited partnerships that go out and buy raw land or old commercial plazas that we believe can be converted into high density residential sites. So to go from a plaza that's producing, let's say, $200,000-$300,000 of income a year to that we bought for, I'm just gonna make up numbers here, but let's say like we buy a plaza for $10 million and it produces $500,000 worth of income, you're buying it at a 5 cap. But if I can convert that plaza site into a high density residential site, it gets sold on a per square foot basis, not on income. And let's say that I get zoned for 200,000 square feet and the average price per buildable square foot for land in that area trades for $100 a square foot. That means that I've taken something that I bought for $10 million, I've turned it into something that's worth $20 million. 200,000 square feet times $100 a square foot is $20 million. So you can see this gigantic value creation that gets created. That's the super enticing part of these private investments. You have a very hard time doing that in publicly traded vehicles because there's an expectation from investors to see income and returns on an annual basis. When you're doing these private investments, it's the income is much more lumpy. So you're going to put in money, you're going to wait 2 or 3 years to complete the value add proposition that you're saying you're going to do. And then you're going to come back and you're going to say, wow, this thing that was worth 10 is now worth 20. So everybody's doubled their money or whatever it is. That's one reason why the private limited partnership route works. The other is that sometimes people that want to get into real estate just don't have the ability, resources, or infrastructure to go and build a publicly traded vehicle. To do the public stuff, you need a couple $100 million of assets under management at least for there to be economies of scale and you to afford the administrative side of being public, while being on the private side allows you to do different sizes of projects. You can do a private project from 1 to 2 million all the way up to 20, 30, 40, $50 million. Excuse me, 20, 30, 40, $50 million. But it's all dependent on the types of investors that want to go in and their appetite for what they're doing. But there's a lot more flexibility on the private side, on the limited partnership side, to allow you to do that. For somebody that's getting into the industry, you're likely going to start by doing private real estate vehicles with accredited investors versus jumping into the big boys, the big leagues, and starting to do publicly traded REITs or real estate companies in general. Obviously, there's a lot more to learn and to tackle in this, but I thought this was like a good introduction to give people that maybe don't work in real estate on a day-to-day basis the understanding or the basic understandings of why people do private investing versus versus public investing. obviously, if you have any more questions, feel free to reach out to me in my DMs, or you could ask a question below in the comments and I'll be happy to answer them. Thanks for tuning in, and we'll catch you next time.